All right. We are back with another episode of the Real Estate Investing Club. I hope you guys are having a great day, great week, wherever you are, and whatever day it is for you when you're listening to this. As always, it is Friday on the podcast. I really shouldn't say that anymore because I've been recording on Wednesdays and Thursdays, and you guys never know, but usually it's Fridays. And so we're bringing that good Friday energy to you. This is going to be a good day because we have Whitney Elkins Hutton with us on the show from passiveinvesting.com, the best domain purchase in history. That's a good one. Whitney is the director of investor education at passiveinvesting.com, founder of Ashwealth, and author of the award-winning bestseller Money for Tomorrow: How to Build and Protect Generational Wealth. They have tons of experience, 800 million in assets, including residential units, express car washes, self-storage, my favorite. So there's a lot to go into here. Whitney, I'm excited to jump into it. Thanks for hopping on.
Absolutely. Thanks for having me.
Yeah, and I will say we have been having a little bit of technical issues this morning, so we're crossing our fingers that does not happen happen going forward. But if it does, guys, just stick with us. We'll get it figured out. Whitney, I told you before we got on here, we always like to start with stories. We like to hear how people got to where they are. So why don't you take us back to the beginning of your story in real estate and tell us how you got here?
Yeah, definitely. Well, I'll start where I'm at. So, I'm the director of investor education at passiveinvesting.com. We're a private equity firm out of the Carolinas, and we have over 1.4 billion assets under management in residential, self storage, express car washes, hotels, real estate debt. What you read was my personal portfolio. And
Mm.
so I didn't start off knowing how to do this. I didn't start off like, getting a degree in finance or real estate or anything like that. I actually started off about 24 years ago now, buying a house with a significant other completely by accident. Um, they were the ones that knew how to swing the hammer and do all the cool stuff like the drywall, tile, and all that. I had the money. I was working in public health at the time. It's kind of funny that I say I had the money. I was working in public health, which you don't have money, but I had a way to figure out the
That's
money.
some money.
I had a little bit of money. Yeah, I had a job. I had a steady job. Um, so we took down a rehab property, and the intent was, buy a house, get married, maybe start a family, and that's not how life went. About a month later, the relationship crumbled, and I ended up with a house, and also one that had been dismantled because all the projects had been started.
Mm.
So I, over the next 11 months, I stuffed that property full of roommates because I couldn't pay the bills on my own, or at least I thought I couldn't. People that didn't mind living in a construction zone and trading work, um, pizza, beer, sushi for tiling floors and drywall, plumbing, you name it. I bought the Home Depot 1, 2, 3 book, taught a lot of things myself, which drywall is not my fave, and I should never do plumbing ever again. Long
I
story
uh,
short,
I tried to hang drywall one time on one of my first flips. I tried to hang drywall and it was a disaster. It was
it is
just
an art.
it is so much harder than it looks to actually hang drywall, especially on the ceiling. It's just like, oh man, I'm never doing that again. I'm definitely not a contractor. That's what I learned from that experience.
I can hang cabinets, I can paint, I can resurface floors. I can even do electrical, but drywall, never again. So 11 months later, I sold the property. Thought I was just like squeaking even, right? Like, wiping my brow, like, ooh, I'm out from underneath this deal, and walked away with a 52K check, tax free because of the 121 exclusion. Oh, by the way, when I did my taxes, I realized I had not been paying any of my expenses for the past 11 months because my roommates covered everything. And that's
Mm.
where the light bulb went on for me. I'm like, how many more deals can I do? Because I actually made more money on my nights and weekends than I did at my day job that had me traveling, like
Mm.
sometimes 80 hours a week. So
Oh, jeez.
continue to live and flip in house hack. Eventually, just married my husband, and he was like, "This doesn't pay the bills. All this flipping. How can we hold on to the properties and put tenants into them?" Which was novel. Like, I'm like, why didn't I think of that?
Oh, that's
Uh,
crazy.
right? Yeah. So we scaled 40 single family rentals through the Burr method, and then got into a 52 unit apartment building in partnership, and then hit an inflection point. This is decade and a half later. Like, how do we continue to scale? here. Do we want to do it actively or passively? So I said yes to both and helped scale a private equity firm. Um, and was the GP on 10 multifamily assets. And then also at the same time, really doubled down on scaling my passive portfolio. Started off with in my retirement accounts, but then I saw the power of doing it outside of my retirement accounts and using depreciation to shelter income. Long story short, that's over a short 24-year period, that's how I ended up with the asset structure that we have today.
Nice. I love it. And there's a lot to go into there. I like how you started. I mean, I've heard this story, your episode 612, I think, and I've heard this story over and over again where people, they just kind of fall into real estate and they have a house and then they start renting out the rooms and they're like, holy crap, this is actually working. And then one thing leads to another. And down the road, they got 500 units, 5,000 units, whatever it is. And things start to snowball. And that's always why, when we hear these stories, I like to turn it back to you, the listener. If you guys are thinking about getting into real estate, start the ball rolling. Start that snowball starting going down the hill, because once you get that first deal done, it starts to pick up speed. And 10 years down the road, you're going to be thankful that you got started sooner rather than later. But yeah, with that said, let's go back to your story. So you've been into a lot of different assets. You started in single family, you did some house hacks, some flips, and then you got into multifamily. And since then, you've branched off into self storage, car washes, etc. Tell us why you chose to diversify yourself across the different asset classes. And yeah, we'll just start there. Why did you choose to diversify across the different asset classes?
Mhm. Yeah. So I was really good at doing residential real estate. And when I started, looking to diversify into other asset classes, me being, the probably hyperachiever driven person that I am, I'm like, oh, I'm going to do it all myself. And that's when I was like, wait a second. My highest and best use of time is to stay focused on what it is I'm really good at and then find other people to invest through or to partner with to take down these other deals. And so that might mean I go into a self storage or express car wash deal passively. It might mean I go into an JV relationship where, I'm the one, helping source, find the deal, bring together capital, handling, back end, customer relations stuff, money partner, right? So, but it's kind of, I think it was Dale Carnegie that said, put all your eggs in one basket and watch it like a hawk. And that's where I was like, you know what I'm really good at is multifamily.
Mm,
Residential real estate. If I start kind of spreading myself too thin, I'm going to hit burnout.
mm.
So, that's the reason why I started doing it. There's also other benefits. We would like to think all these assets cycle, opposite of each other, which they do a little bit. The last 3 years probably has not proven that theorem to be true, because all of them were exposed to interest rates, raising, tax increases, insurance increases. But on a whole, generally, like self storage cycles differently than multifamily and car washes and the like. So
Yeah.
there's diversification there. Where I've really been focused on in the past 3 years is not just diversifying asset classes, but my investments in the different layers of the capital stack. So as opposed to going into all equity deals across different asset classes and being all in the common equity class, who is highest risk, highest reward, first to, hopefully you're making a lot of money on exit, but you're also the first to lose money, like if the market turns. So you better be able to hang on there and wait that out, right? If you're active, passive, it doesn't matter. You better be able to hang on in order to get to the next good part of the market cycle. I was like, wait a second, what if I had other layers to my investing, like some senior debt positions, debt fund investments, maybe some promissory note positions, and the like, other cash flowing businesses that just were uncorrelated to equity positions in real estate entirely.
Oh, interesting. Okay, so you've been more focused on diversifying the type of, you're not really buying properties, but you're investing in the debt side of things.
I do
Thank you.
both still. I'm a goober. I like property. I like real estate. If I find a great deal, I'm taking it down. But From a passive standpoint, why take a square peg and try to smash it into a round hole right now? What is the market giving us? And so right now, debt is still, you know, making, cash hand over fist. Premiums are still at a command. And there's specific type of debt structures like, you know, um, hard money lending is kind of where I'm sitting at right now. And that way I can continue to build cash flow. I can allow it to compound so I get some equity growth there. I'm remaining liquid and flexible. That way, when I do find the next equity deal, like I'm ready. I'm ready to pounce.
That's interesting. I've heard quite a few people just recently start up their own hard money fund. And I'm curious why that is, because I've been in real sense state since 2014, and I didn't, hard money has always been a thing, but for some reason this last, I don't know, year and a half, everybody and their mother is starting hard money lending. Why? What is it about the market right now where hard money is attractive as a fund to start?
So, okay, we've been doing hard money since 2020. So, I mean, maybe we're one of the OGs now. One of our managing partners, she's been doing hard money lending since 2004 or 5.
Hmm.
Personally, founded a company in 2007. So she's seen it all. She's seen the collapse too. Um, I think there's several different, if I had to guess, one, operators themselves are trying to diversify their portfolios. Maybe they can't, actually raise capital on an equity deal, but they can on a debt deal.
Mm,
Also, that's an opportunity for them to bring in different type of investor to their investment to their investor base. But just like anything else, you have to evaluate the operator's track record, background, and experience in that type of investment. So, just everybody and their mother opening up a debt fund, it may not be a good thing. Um, if we
yeah.
look at the market perspective, yeah, especially in the area we play in, which is residential real estate. So think of fix and flippers that are doing 3 bedroom, 1 bath remodels or 3 bedroom, 2 bath remodels. Plain Jane, super conservative investments. We're not doing build to rent, ground up construction, multifamily. We're not doing all the riskier assets right now. Those type of investors, I did 40 of these type of loans myself. I was on the other end. I was the borrower. Like, what do I care about? If I have a single family house and maybe somebody's listening to this, if you are taking down a house and doing a burr, yeah, the interest rates are, probably 12 to 14% for you right now in this market. So all the different funds are fairly competitive on rate and origination points and fees. How do they differentiate? Is their ability to close incredibly fast in their customer service. And so that's what you want to be looking at as far as the lending side of the business. Um, you know, wh- so what does that mean for the borrower? Like they're pretty price insensitive. Um, and when I was doing, fix and flipping, flipping it into my own portfolio. I mean, that was like 10 years ago, and the rates were like 11 to 13%. So they really haven't gone up that much.
Yeah. Yeah. And hard money lending, it's very local. It's very like location dependent because, well, as I understand, I don't run a fund and I've never lent out my money, so I'm not really one to speak. But the people that I have it, spoken with, it sounds like you only really lend to people in your market. You're not, and you might be able to speak better to this. You're not willing to go outside of that because you can't know the value of whatever asset it is, whatever home that you're buying, outside of the places that you actually work and you actually do understand those values. Are you guys very kind of tied down to your specific market, or do you guys lend nationally?
So we are more of a focused lender. So we're not one of the big institutional guys that has boots on the ground in every state, and even having a representative in every state, that person can't even know all the markets in that state. They're playing a numbers game. So
Mm,
if you're an investor, their default rate is probably somewhere between 3 to 10%. If you're going to be investing in a fund and it's a local lender, and their default rate better be down like under 2%, or if not closer to 1%. And that's the area that we play in. We love lending in the Carolinas. Our managing partner and our director of Rehab Wallet, I don't know if you saw my mug, that guy. They've been fix and flipping in these markets for 25 years. They know them.
Mhm.
They can look at an address on an application and they'll be like, "Oh yeah, we did 3 deals like around the corner like in the past 2 years." So that there's a lot of value to that.
Yeah.
We have followed our borrowers into other markets. Um, and so we only if we're going to go into another market, we only change one variable at a time.
Yeah.
But it does really require expertise, right? The lender has to be able to underwrite the borrower incredibly well as the asset. Because at the end of the day, if something goes wrong, what do you end up with? You end up with the asset, the keys to the asset. So that lender has to intimately know that asset.
Yeah.
Um, so you're going to make money if the lender can do that.
Yeah. Yeah, yeah, makes complete sense. Um, so we are surprisingly running the clock down already, but before we moved on, I wanted to talk a bit about car washes because that is something that I've always wanted to own, probably because I just love going through them. You got, the stuff going on, and it's like its own little I don't know, ride going through one of those things. So I've always been interested in them, but I've never actually looked into it. I haven't taken any action to actually buy one. So yeah, I'd love to hear how that's gone. Why how many do you guys own, and why are you interested in car washes?
Yeah, so we own 30, primarily in the Southeast, part of the United States. So we're staying pretty local. We've scaled our own property management company, which is a unique part of the niche, and what allows us to build scale. We got into car washes, as a cash flow play and a diversification play for our investors. We started in the space, like really diving in during 2019. We launched our first car wash, I believe, in 2022.
Oh,
Um,
you built ground up. You're not buying car washes,
no,
you're building.
both. We've largely acquired from mom and pop organizations, and then we
Mm,
have done ground up construction. And there's pros and cons to both. We can get into a lower basis if we do ground up construction. There's speed of close if we are buying from a mom and pop operator and then optimizing operations after that.
mhm.
But it's the way we structure it for our investors. It's a cash flow play backed by real estate, and it may not be immediately cash flowing. If we're taking over like and rebranding everything and putting in new equipment, it might be cash flowing, high cash flow in like 2 to 3 years. Um, and we're specifically in the express car wash piece. We're not in the ones where you like scan your credit card and you wash your own car. We're not in the full service car wash. We're not in the ones that are cost centers attached to a gas station. We're specifically
Oh,
in the
these are
express
the
car wash.
ones where you drive in, it's like a bay, and you drive into them, and you wash them yourself. Is that express? I don't.
No, no, express car wash is like kind of like the Chick-fil-A of like car wash. So you're gonna drive on the property. You might, if you want to vacuum your car, you can pay somebody else to do it. And then it's gonna go through like a 60 to 120-foot long tunnel,
Right.
which
Okay.
will
Okay.
read a
Yeah.
reader, and
Yeah.
that tunnel will do everything based on the subscription or the car wash you've purchased.
Huh.
So and we can wash 450 to 500 cars a day with just 2 to 3 full-time employees on the premise.
Damn.
So, if labor, in a cash flowing business, labor is your number one controllable expense. So, we
How do you underwrite those things? Are you? I mean, it's. I mean, I don't want to speak any further than that. How do you guys underwrite those things? Like, what
very
are you
carefully.
buying them on a cap rate basis, or are you doing it like how what do you look at when you're considering buying a car wash?
Okay, well, this is a whole other episode in and of itself, but, we're buying based on a multiple of EBITDA. So,
Okay.
which is kinda like net operating income in
Hmm.
multifamily real estate. Okay, so
Yeah.
to kinda so, EBITDA, we're probably paying somewhere between 7 to 10, earnings before depreciation, interest, taxes, insurance, and amortization. Okay, what does that all mean? Essentially profit.
Yeah.
Okay, true profit on the asset, and we'll pay a multiple of
It's
that.
it's like cash on cash return, right?
Yeah. Um, So that's how we determine the valuation. But how do we kind of underwrite? We love the tertiary markets. Secondary to tertiary markets. There's just been hyper supply that's come online in the primary markets, and even some of the secondary markets. It was kind of a churn and burn there for a while. People were just building these express car washes and then offloading them.
Mm.
You want to be in the kind of the Saturday morning pattern, of people running errands, going
Right
into
next to
cleaners,
Starbucks. Yeah.
yeah, grocery store, all that sort of thing. And you want to look at your competition. So it really boils down to location, 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 and location.
Yeah.
So, what major metropolitan service area, the submarket of that service area, are you on the right side of town? And are you literally on the right
On the
side
right
of the
side of the
street
road. Yeah.
where 20,000 cars are passing you on average a day and can make a right-hand turn into the parking lot? Like,
Yeah.
you want to be that easy to get to.
Yeah. Yeah, that's funny you say that because I'm thinking of this one car wash that I go to by my parents' house, and I there's two car washes in the area, and I always go to this one because it's just it's easier to access. It's on the right side of the road. And so yeah, that's interesting. All right, well, we have run down the clock. We have passed the 20-minute mark, so it is time to jump into the quick question round. Are you ready?
Yes, let's do it.
All right. Starts with education. It could be any form. It could be a book you've read, a conference you've gone to, a mentorship program you've been a part of, any of that. I just need two recommendations, one for general life wisdom and then one for real estate.
The One Thing, by Jay
Gary
Papasan and
Keller.
Gary Keller. Yep.
Yeah.
Just actually got back from that conference this week. Love it. The other one, I mean, I'll plug my book. It's more for what should the real estate investor do before they actually pull the trigger on an investment, or if you're in an investment, and you're feeling nervous about the market, there's probably something you missed in your financial foundation. And so that book is Money for Tomorrow.
Nice. All right. And probably get that on Amazon.
You can grab it on Amazon or biggerpockets.com.
Perfect. All right. Next question is for your younger self. Let's go back to the Whitney who is just getting that, that I think you said a rent by the room house way back in the day. The first one. Go back to her, look her in the eye, and give her one piece of advice moving forward.
Oh my gosh. Um, Read the book cover to cover. I would hand her my book, right, if it's
Hmm.
written. Um,
Nice.
but also, my realtor had given me Rich Dad Poor Dad, and I read like the first couple chapters, thought I had it all mastered, and I put it down. And my second deal totally proved that I did not read that book cover to cover.
Rich Dad Poor Dad. That's a classic. It's timeless. I don't know how many times people have come on here and recommended that one, but it's for good reason. It kind of shows you the framework of how to operate in real estate and why you should be doing it. So,
Let me change that. I would actually have her read Cash Flow Quadrant. I think
oh,
that
okay.
follow-up book, the second book, for me was, I have an operational brain, so you start telling me stories and I might like go to sleep and check out. But like Cash Flow Quadrant, like that would have probably hit home for sure. I probably would have read that one cover to cover.
I've heard of that. I actually have not read that one, but I've heard it's a good one. So, I'm going to move us on to the next question. This is about the U.S. It is a big place. There is a lot of opportunity out there. Give me the single metro you're most excited about investing in today.
That is not how I operate. Um, I would say, I'll give you kind of states. I'm still really excited about North Carolina and South Carolina. Um, Not because that's where our company is from, but there's just, macroeconomics, the movement of business into those major metropolitan service areas. That's a tailwind that people can ride for quite a long time.
Yeah. Yeah. North, South Carolina, those have been mentioned a lot of times on the show for good reason. I mean, all the major metros in there have like nearly double digit growth in the past year. And so it's crazy. And it's good. It's good for the real estate. Next question is about finding deals. It all starts with getting in contact with a seller and penning that purchase agreement. So, what is your favorite way to generate leads and find new deals?
Generating leads. I honestly, I like just simple setting up simple web searches. Like if I'm gonna like take down a deal myself, finding a realtor, talking to other investors who also are investing in that market because oftentimes they may not be able to take down the deal themselves. And
Mm,
so you can either get an assignment from them or maybe JV with them.
nice. I like it. Next question is about lessons lessons learned. Not every deal we get into goes the way we expect it. In fact, pretty much every time something's going to go wrong, and that's when we get to learn a lesson. So, what was a deal that went a little bit sideways for you, and then what was the lesson you pulled from it?
Oh my gosh, I have so many of those. I'll tell you one that wasn't bad tenant related, and I did a flip, and I did not. The person who was repairing the roof did not close the soffits before the weekend, and so the house had raccoons in it. We get the exterminator, we get the raccoons out of the house. The new roof goes on, but they didn't close the soffits all the way. Raccoons love to party. They came
Got
back.
back in.
And then we had just hung all new drywall in the house.
Ooh,
Yes.
bummer.
So got to do that twice.
What's the lesson there? I guess it's just make sure the soffits are closed.
Double check, right? Like, so what I should have had is I should have had the contractor take a video and walk around the house
Hmm.
or had my property manager go out there and double confirm that only because we knew that if we did not close those soffits up, um, you know, like raccoons can be trained to go somewhere else, but not just when you just kicked them out of the house, right?
Yep.
They're like, "Oh, hotel's open again. Let's go back."
Yeah, simple videos are it's such a underrated way of checking in on a property. In fact, one time when I was looking at an industrial property out in an area that I couldn't access myself, and so I went onto Grubhub or like DoorDash or something like that, and I bought a burger and I shipped it to this place. And in the description, I told the person like, "This burger is yours. Just take a picture of the property and send it to me." And it worked out. And it was it's a really easy way to I spent $10 on that burger and I got a video of the entire property. So it's a really, really easy way and a good way to kind of understand what you're buying and maybe check in on your property, anything like that.
Grubhub hack. I'm gonna use that. I love it.
Yeah, yeah, I thought it was pretty slick. All right, next question. We just talked about lessons learned. Let's talk about your highlight reel. Sometimes things do go right and they go as expected, and it stands out in your mind as one of your favorite deals. So go back to your highlight reel. Which is a deal that kind of stands out as your favorite?
I feel so. Um, That's really interesting because played in the space of all burr type properties, and so you always are dealing with an issue. I'll talk about one of our current properties that we're still holding. We haven't exited it yet. We dealt with everything. It's a 2-unit property, so a main house with an EDU. Uh, Challenging market, right? During COVID, we still had to rent back to the previous owner because he couldn't leave the property. So there was all challenges around that. Our inspection, we thought we had everything dialed on the inspection, but a year later we realized that so there had been a lot of rehab that had occurred on the property, and the certificate, the CO, had been signed off on,
Hmm.
but nobody went under the house to check that if the plumbing
Oh,
had been put back together.
ooh,
Yeah,
that sucks.
that's a big deal. So, the owner never went under, the person actually who signed off on the CO never went under. They all took the original plumber's word that this been put back together. And so
Just
for,
dumped into the ground.
10
Yeah,
years, the main shower had been draining into the crawl space
for 10 years. Wow,
for 10 years.
that's
And so we
crazy.
go to have to put in a new boiler. So we have to go in and reroute all the plumbing underneath the house. And the plumber is like, "Oh my gosh, you have black mold." And it turns out it was just like wet soil. Um, we remediate that. Anyways, long story short, we get it all back together. We get the video that the shower had not been connected, which means our person that we paid to do the inspection on the property never went under the house either to double
Yeah.
check that.
I actually, sorry to jump in. I just had this happen on the house we just bought. The toilet had been just draining into the freaking into the crawl space. And this was not called out in the inspection report. We figured this out after we bought it, and we wanted to change the bathroom, so we tore it out and started doing everything. But we figured it out afterwards. We're like, why didn't you catch this? This is a ridiculous thing not to catch.
Well,
Anyways, so
so the crawl space is super tiny. Like I can get into it, but my husband can't.
Mm,
Right? So I understand the inspector probably just went, whoop, well, somebody got under there at some point in time, signed off with the CO. It's good, right?
yeah.
Long story short, we found somebody to get under there, get it all repaired. We have had the plumbing disaster on this house, and I better knock on wood because maybe I'll get a call from my tenant today on some other issue. But that one has been a great property for us. We're really proud to kind of navigated all those challenges. It's turned into one of the most amazing rentals that we've held. Also, what this is a community that is super challenged with rentals, and so we're glad to be able to hold it as a rental and not be forced to go into short-term rental or midterm rental on it,
Mm, mm.
and have to charge higher pricing. And then at some point in time, we're going to move into it and retire in that house. So
Oh, nice.
yeah.
Yeah, those are the best. The ones that you see yourself living in them, and you're like,
Mhm.
I'm glad somebody else gets the opportunity to live here as well. That's pretty cool.
Oh, I'm gonna get it before I move into it,
Right.
but for right
But
now.
but the location, you like the location.
Yes.
All right, moving us on. This is a new question that we've added. Sorry, guys, I keep getting coughs this morning. New question that we've added to the podcast. This is about AI. I'm a huge proponent of it. I like to implement it in as many places as I can responsibly do so. So the question is, how are you implementing AI into your business? And yeah, that's pretty much it. How are you implementing AI into your business today?
Well, as the director of investor relations or investor education and passiveinvesting.com, I use it a lot to think through topics that the passive investor needs to hear about. And so I don't just say, hey, write a blog post on this topic or write a video outline on this topic. I really put it in. Jeff Woods wrote a book, The AI Driven Leader. And so he has a model in there. It's called CRIT. It's an acronym for how to write a good prompt. And so
Mm,
I always have the AI interview me. That way it's extracting the information out of my head and what I would want to
mm.
see as a limited partner investor. And so I use AI for all my content, but the content is 100% me. You're not getting some AI slop or chatbot that generated something. It's all me. It's coming from my head.
Yeah, very cool. And so that's interesting. That's a new way that I've heard to interact with LLMs is you ask it to interview you about a specific topic and have it ask you questions, and then you respond for it to kind of synthesize into something coherent.
Can I give you the model real fast?
Yeah, yeah, for sure.
So, CRIT, CRIT. Again, read the book AI Driven Leader. But the first thing you're going to say is, here's the context. This is what I'm trying to do. Your role, ours for role, your role is to, you know, be the editor
Yeah.
or social media producer, whatever, right? Then you're going to say, interview me and ask me questions one at a time for clarity and context, and maybe give it a cap on the number of questions, 3 to 5 questions, because otherwise you'll go down a rabbit hole like forever. And then uh, the task, what is the outcome that you want it to produce? That's the
Oh,
T.
okay. So after the questions, after you've asked the questions, do this with the responses that I've given you.
Mhm.
Create a blog post, create a description for the whatever the thing is, make a post for me that I can put on LinkedIn. Yeah, that makes a lot of sense. So crit, CRIT, context, what was R?
Role. So you put it
Role.
in a role.
Yeah, that makes sense. You are the copywriter for my website or whatever that is.
Yeah,
Con-
you're the copywriter for my website, and my target audience is X, Y, and Z. And this is what they struggle with most. The more information you can give it, the better.
nice. That's really cool. I like that. All right. Well, with that, I'm going to move us on to the very last question. This is for the listeners. I'm sure you've given us a lot to think about. I'm sure people want to reach out, get in contact with you. This is a two-parter. Where can they find you? And then what can they expect when they reach out?
Absolutely. You can find me at passiveinvestingwithwhitney.com. When you go there, that you can fill out a quick form. We can jump on a one-on-one call together and understand your investing goals. My goal in life is to help investors take their active income in savings and turn it into passive income and long-term wealth. So we can start there with the conversation. We also will, send you some free education, probably more than you ever wanted to know, about how to do that.
Awesome. I will put that link in the show notes. So if you guys want to reach out to Whitney, all you got to do is click the little more in the description. It's going to pull down that full description, and in there you can find her links. All right, Whitney, that wraps it up. Thank you very much for hopping on the show.
No, thank you so much for having me on, Gabriel.
Absolutely. For everybody who's with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions, reach out to me, Gabe at therealestateinvestingclub.com. And I will say quite a few of you have actually been reaching out more recently, and I absolutely love it. So really, if guys do have questions, reach out to me. Love to hear from you. Other than that, I hope you guys have an absolutely fantastic week. Keep rocking real estate, and I look forward to seeing you on the next episode.